Question 1. The control framework reveals that a significant, long-term insurance contract has not undergone a formal risk profile review for over 3 years, despite its substantial premium income and exposure to evolving market conditions. Which of the following represents the most appropriate approach to address this situation in line with London market insurance principles and regulatory expectations? Option A. Accept the current risk assessment as sufficient, given the contract's long-standing nature and the absence of any recent adverse claims history. Option B. Delegate the responsibility for a review to the most junior underwriter in the team to gain experience, with no specific deadline or oversight mechanism. Option C. Initiate an immediate, comprehensive review of the contract's risk profile, incorporating current market data, client operational changes, and any relevant regulatory updates, and establish a schedule for future periodic reviews and define trigger events for ad hoc reviews. Option D. Continue with the existing practice of reviewing the contract only if a significant claim arises, as this indicates a materialization of risk. The correct answer is C. Initiate an immediate, comprehensive review of the contract's risk profile, incorporating current market data, client operational changes, and any relevant regulatory updates, and establish a schedule for future periodic reviews and define trigger events for ad hoc reviews. Explanation. The control framework reveals a potential gap in the ongoing monitoring of a significant insurance contract's risk profile. This scenario is professionally challenging because it requires the underwriter to balance the need for proactive risk management with the practicalities of managing a large portfolio. A failure to adequately monitor risks can lead to unexpected losses, reputational damage, and regulatory sanctions. Careful judgment is required to determine the appropriate level of review without becoming overly burdensome. The correct approach involves establishing a systematic process for reviewing the risk profile of significant contracts at predetermined intervals and in response to specific triggers. This approach is right because it aligns with the principles of prudent underwriting and regulatory expectations for effective risk management. Specifically, the Financial Conduct Authority (FCA) Handbook, particularly SISC Systems and Controls, and ICOB's Insurance Conduct of Business Sourcebook, mandates that firms have adequate systems and controls in place to manage risks effectively. Regular and triggered reviews ensure that the firm remains aware of evolving risks and can take timely corrective actions, thereby fulfilling its duty to treat customers fairly and maintain financial soundness. An incorrect approach of relying solely on the initial underwriting assessment fails to acknowledge that risks are dynamic. This neglects the regulatory requirement for ongoing oversight and can lead to a situation where the firm is exposed to risks it is no longer adequately equipped to manage. Another incorrect approach of reviewing only when a claim is made is reactive rather than proactive. A claim's data is valuable. Waiting for a claim to occur before reviewing the underlying risk means that potential issues may have already materialized, leading to financial losses and potential customer detriment. This falls short of the FCA's expectation for robust risk management frameworks. A further incorrect approach of delegating the review entirely to a junior team member without senior oversight is also problematic. While delegation can be efficient, ultimate responsibility for risk management rests with senior management and the board. Inadequate oversight can result in critical risk factors being missed or misinterpreted, undermining the effectiveness of the control framework. Professionals should employ a decision-making framework that prioritizes a risk-based approach. This involves identifying significant risks, assessing their potential impact, and implementing controls commensurate with that risk. For risk monitoring, this means defining clear review triggers, e.g., changes in the economic environment, regulatory updates, client operational changes, and establishing a schedule for periodic reviews, ensuring that the process is embedded within the firm's overall risk management system and overseen by appropriate levels of management. Question 2. Compliance review shows that a London market insurer has entered into both a quota share and a surplus treaty reinsurance arrangement. The insurer's finance department has prepared its regulatory solvency return, but the compliance officer is concerned about the accuracy of the treatment of these reinsurance contracts in relation to the insurer's net premium income and its solvency capital requirement, SCR. Specifically, the compliance officer questions whether the accounting for ceded premium and the impact on outstanding claims reserves accurately reflects the regulatory requirements as stipulated by the Prudential Regulation Authority, PRA. Which of the following approaches to accounting for these reinsurance treaties would be most compliant with the PRA's regulatory framework for the London market? Option A. For both the quota share and surplus treaties, the insurer has recognized the gross premium income and has not adjusted its outstanding claims reserves, arguing that the reinsurer will ultimately cover these. Option B. For the quota share treaty, the insurer has recognized only its net retained premium income and has adjusted its outstanding claims reserves to reflect the reinsurer's share of liabilities. For the surplus treaty, it has calculated its SCR based on the net line retained by the insurer, accounting for the excess lines covered by the treaty. Option C. For the quota share treaty, the insurer has recognized the full gross premium income and has not adjusted its outstanding claims reserves to reflect the reinsurer's share. For the surplus treaty, it has treated the entire risk as ceded, reducing its SCR accordingly. Option D. For the quota share treaty, the insurer has recognized the gross premium income, but has reduced its SCR by the full amount of the ceded premium. For the surplus treaty, it has treated the retained line as the only exposure for SCR purposes. The correct answer is C. For the quota share treaty, the insurer has recognized the full gross premium income and has not adjusted its outstanding claims reserves to reflect the reinsurer's share. For the surplus treaty, it has treated the entire risk as ceded, reducing its SCR accordingly. Explanation. This scenario presents a professional challenge because it requires a deep understanding of how treaty reinsurance, specifically quota share and surplus treaties, interacts with regulatory solvency requirements in the London market. The challenge lies in correctly interpreting the regulatory treatment of these reinsurance arrangements to ensure the cedent company maintains adequate capital and reserves, as mandated by the Prudential Regulation Authority, PRA, under the Financial Services and Markets Act 2000 FSMA, and associated PRA rulebook. Misinterpreting the regulatory impact can lead to understating liabilities or overstating capital, potentially jeopardizing the insurer's financial stability and breaching regulatory obligations. The correct approach involves accurately reflecting the ceded premium and claims within the cedent's financial statements and solvency calculations according to PRA guidelines for reinsurance. For quota share, this means recognizing the ceded portion of both premium income and claims paid, thereby reducing the cedent's net exposure and associated reserve requirements. For surplus treaty, the cedent retains a net line, and the treaty covers excess lines, impacting the cedent's exposure and capital requirements based on the retained line and the treaty's capacity. The regulatory justification stems from the PRA's objective to ensure that insurers are financially sound and can meet their obligations to policyholders. The PRA rulebook, particularly sections related to solvency capital requirements, SCR, and minimum capital requirements, MCR, dictates how reinsurance is treated to avoid double counting of capital or underestimation of risk. An incorrect approach would be to treat the ceded premium as pure income without accounting for the corresponding reduction in risk and liabilities, or to fail to adjust the reserve calculations to reflect the reinsurer's share of outstanding claims. This would lead to an overstatement of net premium and an understatement of net liabilities, potentially resulting in a breach of solvency requirements. Another incorrect approach would be to incorrectly apply the principles of surplus treaty, perhaps by treating the entire risk as ceded when only the excess lines are covered, or by not adequately considering the impact of the retained line on the cedent's capital needs. Such misapplications would misrepresent the cedent's true risk profile and capital adequacy, contravening the PRA's prudential framework. Professional decision-making in such situations requires a thorough review of the specific treaty wording, an understanding of the applicable PRA rules and guidance on reinsurance, and consultation with actuarial and compliance departments. It involves a critical assessment of how the reinsurance arrangements affect the cedent's financial position and regulatory capital, ensuring that all disclosures and calculations are transparent and compliant with the spirit and letter of the regulations. Question 3. System analysis indicates that a syndicate is facing a claim for business interruption arising from a novel cyber event that has caused widespread disruption to the assured's operations. The claim is substantial, and the cause of the disruption is complex, with arguments emerging about whether it constitutes a peril covered by the policy. The syndicate's claims team is considering how to approach this situation, balancing their duty to the assured with the need for prudent financial management. Option A. propose to the assured that the policy terms be amended retrospectively to exclude coverage for such cyber events before processing the claim. Option B. Conduct a thorough investigation into the nature of the cyber event, the assured's legal liability, and a detailed review of the policy wording, including any relevant endorsements or exclusions, to determine if the claim falls within the scope of coverage under the follow the fortunes principle. Option C. Immediately reject the claim based on the novelty of the cyber event and the complexity of establishing causation, citing the potential for significant financial impact on the syndicate. Option D. Accept the claim in full without detailed investigation to maintain a positive relationship with the assured and avoid potential disputes, regardless of the precise policy coverage. Correct answer is B. Conduct a thorough investigation into the nature of the cyber event, the assured's legal liability, and a detailed review of the policy wording, including any relevant endorsements or exclusions, to determine if the claim falls within the scope of coverage under the follow the fortunes principle. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between the insurer's desire to manage its exposure and the policyholder's expectation of coverage under the terms of the contract. The challenge lies in interpreting and applying the follow the fortunes principle in a way that is both commercially sound for the insurer and ethically compliant with the principles of good faith and fair dealing expected in the London insurance market. Misapplication can lead to disputes, regulatory scrutiny, and reputational damage. Correct approach analysis. The correct approach involves a thorough review of the underlying claim and the policy wording to determine if the claim falls within the scope of coverage, even if it is a novel or complex claim. The follow the fortunes principle, a cornerstone of the London market, dictates that an underwriter should generally follow the fortunes of the assured, meaning they should pay claims that the assured is legally liable to pay, provided the claim is covered by the policy. This approach requires the underwriter to act in good faith, conduct a reasonable investigation, and not seek to avoid liability based on technicalities or a desire to reduce payouts, unless there is a clear breach of policy terms or exclusion. The regulatory framework for the London market, including guidance from bodies like the FCA and PRA, emphasizes fair treatment of customers and adherence to established market practices. Incorrect approach is analysis, an approach that immediately seeks to deny coverage based on the claim's unusual nature or the potential for significant payout, without a detailed investigation into the policy terms and the assured's liability, fails to uphold the follow the fortunes principle, and demonstrates a lack of good faith. This could be seen as an attempt to avoid commercial consequences rather than adhering to contractual obligations. Another incorrect approach would be to automatically accept the claim without any due diligence, simply because it is presented by a long-standing client or to avoid potential conflict. While maintaining good client relationships is important, it does not absolve the underwriter of their responsibility to assess the claim's validity against the policy terms. This approach risks paying claims that are not covered, which can have adverse financial implications for the insurer and its capital position, and could also be seen as a dereliction of duty to shareholders and policyholders who rely on sound financial management. A third incorrect approach might involve attempting to renegotiate the policy terms retroactively or impose new conditions to avoid the claim. This is ethically unsound and contrary to the principle of contractual certainty. The terms of the policy at the time the risk was underwritten should govern the claim. Professional reasoning. Professionals in the London insurance market must adopt a balanced approach that respects the follow the fortunes principle while ensuring prudent risk management. This involves a systematic process. First, understanding the factual basis of the claim. Second, meticulously examining the policy wording, including any endorsements or exclusions. Third, assessing the assured's legal liability. And fourth, making a decision based on a good faith interpretation of the policy and established market practice. When in doubt, seeking legal advice or consulting with experienced colleagues is a prudent step. The ultimate decision must be justifiable under the policy and align with regulatory expectations for fair treatment and sound financial conduct. Question 4. The control framework reveals that a London market insurer is managing a complex, high-value litigation claim. The insured is seeking substantial damages, and the legal team has advised a protracted and aggressive defense strategy. What is the most appropriate approach for the insurer to manage this litigation, considering its regulatory obligations and stakeholder interests. Option A. Appoint experienced external legal counsel with a clear mandate to vigorously defend the claim. Establish a dedicated internal team to monitor progress and costs, and regularly review legal advice and settlement options in light of evolving case law and evidence. Option B. Adopt a purely defensive posture, refusing any settlement discussions unless the claim is demonstrably baseless, to minimize immediate expenditure. Option C. Defer all strategic decisions regarding the litigation entirely to the appointed external legal counsel, assuming their expertise will ensure the best outcome. Option D. Instruct junior legal counsel to minimize hourly rates and limit the scope of discovery to reduce upfront legal fees, without a comprehensive assessment of the long-term impact on the claim's resolution. The correct answer is A. Appoint experienced external legal counsel with a clear mandate to vigorously defend the claim. Establish a dedicated internal team to monitor progress and costs, and regularly review legal advice and settlement options in light of evolving case law and evidence. Explanation. The control framework reveals that a London market insurer is facing a complex litigation matter involving a significant international liability claim. The challenge lies in managing this litigation effectively while adhering to the principles of good governance, regulatory compliance, and fiduciary duty to policyholders and stakeholders. The insurer must balance the need for aggressive defense with the potential for cost-effective resolution, all within the strictures of the UK regulatory environment, particularly as overseen by the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. The most professionally sound approach involves a proactive and transparent engagement with all relevant stakeholders, including the insured, legal counsel, and potentially reinsurers. This entails a thorough assessment of the claim's merits, a clear communication strategy regarding potential liabilities and defense costs, and the establishment of robust internal controls for decision-making and oversight. The insurer must ensure that legal counsel is instructed with clear mandates, that their advice is critically evaluated, and that all actions taken are in the best interests of the company and its policyholders, aligning with the FCA's principles for businesses, particularly Principle 3, Management and Control, and Principle 6, Customers' Interests. This approach prioritizes informed decision-making, cost efficiency, and regulatory adherence. An approach that solely relies on deferring all decisions to external legal counsel without robust internal oversight would be professionally deficient. This fails to meet the FCA's expectations for effective management and control, potentially leading to uncontrolled expenditure and outcomes detrimental to the insurer. It neglects the insurer's ultimate responsibility for managing its liabilities and resources. Another incorrect approach would be to adopt a purely defensive stance, refusing to engage in settlement discussions even when evidence suggests a favorable outcome could be achieved. This can escalate costs unnecessarily and may be seen as failing to act in the best interests of customers or to manage the business effectively, potentially breaching Principle 6. Finally, an approach that prioritizes minimizing immediate legal costs by instructing junior counsel or limiting discovery, without a comprehensive assessment of the long-term implications for the claim's outcome and the insurer's reputation, would also be flawed. This demonstrates a lack of strategic litigation management and a failure to adequately consider all relevant factors, potentially leading to greater financial detriment in the long run, and contravening the duty of care expected of a regulated firm. Professionals should adopt a structured decision-making process that begins with a comprehensive understanding of the legal and factual landscape of the litigation. This involves engaging with experienced legal advisors, critically evaluating their advice, and ensuring that internal governance structures are robust enough to oversee the litigation process. Regular reporting, clear delegation of authority, and a focus on achieving the best possible outcome within regulatory and ethical boundaries are paramount. Question 5. Cost-benefit analysis shows that a cedent is seeking reinsurance for a portfolio of property risks with a moderate frequency of small to medium-sized claims and a low frequency of very large catastrophic losses. The cedent's primary objective is to achieve a stable, predictable sharing of premiums and losses over the long term, while also gaining additional underwriting capacity. Which type of reinsurance arrangement would best align with these objectives and regulatory principles? Option A. Stop-loss reinsurance, focusing solely on limiting the cedent's aggregate annual loss. Option B. a hybrid approach combining a small proportional treaty with a large excessive loss treaty for all claims above a minimal retention. Option C, non-proportional reinsurance, specifically an excessive loss treaty structured to cover only catastrophic events. Option D, proportional reinsurance, such as a quota share or surplus treaty. Correct answer is D, proportional reinsurance, such as a quota share or surplus treaty. Explanation: this scenario is professionally challenging because it requires an underwriter to select the most appropriate reinsurance structure for a specific risk profile, balancing the cedent's needs with the reinsurer's capacity and risk appetite. The decision is not purely financial, but also hinges on understanding the underlying risk characteristics and how different reinsurance mechanisms distribute that risk. The London Market Insurance Principles exam emphasizes a thorough understanding of these principles, including the practical application of reinsurance types within the regulatory framework. The correct approach involves selecting proportional reinsurance when the primary goal is to share both the premium and the losses in a fixed proportion, thereby providing capacity and a stable partnership. This aligns with the regulatory expectation that reinsurance arrangements should be structured to provide genuine risk transfer and support the solvency of the cedent. Proportional treaties, such as quota share or surplus treaties, offer a predictable method of risk sharing and are often favored for long-term relationships and when the cedent wishes to maintain a consistent retention. The regulatory framework, as interpreted through the principles tested in the London Market Insurance Principles exam, supports arrangements that demonstrably transfer risk and enhance the cedent's financial stability. An incorrect approach would be to select non-proportional reinsurance solely based on the potential for reduced administrative burden, without considering the specific risk profile and the cedent's need for predictable loss sharing. Non-proportional reinsurance, such as excessive loss, is designed to protect against large, infrequent losses. If the underlying risk is characterized by frequent, smaller losses, an excessive loss treaty might not adequately address the cedent's need for ongoing loss mitigation and could lead to a misallocation of reinsurance resources. This could be seen as a failure to act with due skill, care, and diligence, as it prioritizes administrative ease over effective risk management and genuine risk transfer, potentially impacting the cedent's financial health and, by extension, the stability of the market. Another incorrect approach would be to recommend proportional reinsurance for a risk with extremely high volatility and a low frequency of large claims, where the primary concern is catastrophic protection. While proportional reinsurance shares all losses, it might not provide the necessary financial cushion for a single, massive event that could overwhelm the cedent's retained portion, even with a proportional share. This would fail to meet the fundamental purpose of reinsurance in providing protection against significant financial shocks, potentially contravening principles of prudent risk management and adequate capitalization. The professional decision-making process should involve a thorough assessment of the cedent's risk portfolio, their retention strategy, their financial capacity, and their stated objectives for seeking reinsurance. Understanding the frequency and severity characteristics of the underlying risks is paramount. The choice between proportional and non-proportional reinsurance should then be driven by which structure best achieves the cedent's goals of risk mitigation, capacity enhancement, and financial stability, in accordance with regulatory expectations for sound insurance and reinsurance practices. Question 6. Cost-benefit analysis shows that implementing a fully automated, real-time claims notification system for every single policy event, regardless of perceived severity, would be prohibitively expensive and administratively burdensome for the syndicate. However, a manual system relying on brokers to flag significant events for reporting to Lloyd's and the FCA is also proving inconsistent, with some potentially reportable events being missed. What is the most appropriate approach for the syndicate to ensure compliance with London Market Insurance Principles regarding claims notification and reporting? Option A. Develop and implement a tiered notification system that categorizes potential claims based on predefined criteria, e.g., potential financial impact, regulatory significance, and establishes clear internal escalation pathways for reporting to Lloyd's and the FCA. Supported by regular training and audits. Option B. Continue with the current manual system, emphasizing to brokers the importance of their role in flagging significant events, and conduct periodic, informal reviews of claims files to identify any missed reporting. Option C. Delegate the entire responsibility for claims notification and reporting to the brokers, assuming they possess the necessary expertise and diligence to manage all regulatory requirements on behalf of the syndicate. Option D. Invest in the prohibitively expensive fully automated system to guarantee absolute compliance, even if it significantly impacts operational efficiency and profitability. The correct answer is A. Develop and implement a tiered notification system that categorizes potential claims based on predefined criteria, e.g., potential financial impact, regulatory significance, and establishes clear internal escalation pathways for reporting to Lloyd's and the FCA, supported by regular training and audits. Explanation: this scenario presents a professional challenge due to the inherent tension between commercial expediency and regulatory compliance when dealing with claims notification. The underwriter must balance the need for timely information to assess risk and manage potential liabilities against the practicalities of receiving and processing numerous notifications, some of which may initially appear minor. The challenge lies in identifying the threshold for mandatory reporting and ensuring that all reportable events are captured without creating undue administrative burden or delaying legitimate claims processing. Careful judgment is required to interpret the spirit and letter of the regulations. The correct approach involves a proactive and systematic process for claims notification and reporting that prioritizes regulatory adherence. This means establishing clear internal procedures for identifying, logging, and escalating claims notifications that meet the criteria for reporting to the relevant regulatory bodies, such as Lloyd's or the FCA, as stipulated by the London Market Insurance Principles Exam Framework. This approach ensures that all reportable events are captured promptly, allowing for accurate reserving, regulatory oversight, and the demonstration of robust governance. The regulatory justification stems from the principles of market conduct, transparency, and the need for regulators to have timely information to monitor the financial health and operational integrity of market participants. An incorrect approach would be to adopt a passive stance, relying solely on the broker to initiate reporting without internal checks, or to dismiss notifications that appear minor without proper assessment against reporting thresholds. This failure to proactively manage the notification process risks breaching regulatory obligations. For instance, failing to report a significant event, even if initially perceived as low impact, could lead to regulatory sanctions for non-disclosure or late reporting. Another incorrect approach is to implement an overly burdensome internal reporting system that stifles efficiency and delays claims handling, which, while seemingly compliant, could indirectly harm policyholders and the market's reputation for efficient service. This could also be seen as a failure to act with due skill, care, and diligence. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory requirements for claims notification and reporting within the London market. This includes consulting the Lloyd's Market Minimum Standards, LMMS, and any applicable FCA rules. Professionals should establish clear internal policies and training programs to ensure all staff understand their responsibilities. Regular reviews of these procedures and internal audits are essential to confirm ongoing compliance and identify areas for improvement. When in doubt about whether a notification requires reporting, the prudent course of action is to err on the side of caution and seek clarification from compliance or legal departments, or directly from the relevant regulatory body. Question 7. The evaluation methodology shows a London market insurer seeking facultative reinsurance for a unique offshore energy installation. Which of the following approaches best demonstrates adherence to London market principles and regulatory expectations for facultative reinsurance placement? Option A. Placing the facultative reinsurance with the reinsurer offering the most competitive premium, without in-depth scrutiny of the reinsurer's underwriting guidelines or claims handling history. Option B. Relying on the reinsurer's standard facultative reinsurance wording, assuming it will adequately cover the specific risks of the offshore installation, and not seeking independent legal advice on the contract. Option C. Accepting the first facultative reinsurance offer received from a reinsurer introduced by a long-standing broker, assuming the broker has performed adequate due diligence. Option D. Engaging a reputable facultative reinsurance broker to identify suitable reinsurers and negotiate terms, with the insurer conducting a final review of the proposed contract and reinsurer's financial standing. The correct answer is D. Engaging a reputable facultative reinsurance broker to identify suitable reinsurers and negotiate terms, with the insurer conducting a final review of the proposed contract and reinsurer's financial standing. Explanation. The evaluation methodology shows a scenario where a London market insurer is considering facultative reinsurance for a complex, high-value property risk. The professional challenge lies in ensuring that the facultative reinsurance placement accurately reflects the underlying risk, complies with all relevant London market practices and regulatory requirements, and provides adequate protection for the said insurer. This requires a thorough understanding of the facultative market, the specific risk characteristics, and the contractual terms of both the facultative treaty and the underlying policy. Careful judgment is needed to select the most appropriate reinsurer and terms, avoiding potential conflicts of interest or misrepresentations. The correct approach involves a comprehensive due diligence process on potential facultative reinsurers, a detailed review of the facultative reinsurance contract to ensure alignment with the original policy terms and conditions, and clear communication with all parties involved. This aligns with the principles of prudent underwriting and risk management expected within the London market, as guided by bodies like Lloyd's and the International Underwriting Association, EUA. Specifically, it adheres to the expectation that insurers act with due skill, care, and diligence, and that all reinsurance arrangements are transparent and properly documented, as underpinned by the principles of the Financial Conduct Authority, FCA, in the UK. The emphasis on understanding the risk and ensuring contractual clarity prevents adverse selection and ensures the reinsurer is adequately informed, thereby protecting the financial stability of the said insurer and ultimately the policyholders. An incorrect approach would be to rely solely on the broker's recommendation, without independent verification of the reinsurer's financial strength and underwriting appetite. This fails to meet the duty of care owed by the insurer to its stakeholders and could expose the insurer to the risk of non-payment by an undercapitalized reinsurer. Another incorrect approach would be to accept a facultative reinsurance contract with ambiguous or conflicting terms compared to the original policy. This creates a gap in coverage for the said insurer, potentially leading to disputes and financial losses, and contravenes the principle of clear and accurate contractual documentation. Furthermore, failing to disclose all material facts about the underlying risk to the facultative reinsurer is a breach of utmost good faith, a cornerstone of insurance and reinsurance contracts, and could invalidate the reinsurance cover. The professional reasoning process for such situations should involve a structured approach. First, clearly define the risk and the desired reinsurance protection. Second, identify and vet potential facultative reinsurers, considering their financial stability, expertise, and capacity. Third, meticulously review the facultative reinsurance contract, ensuring it accurately reflects the risk and aligns with the original policy. Fourth, maintain open and transparent communication with the broker, reinsurer, and internal stakeholders. Finally, ensure all documentation is complete and compliant with regulatory requirements. Question 8. The risk matrix shows a potential for increased claims related to cyber attacks. A cyber insurance policy has been issued with a condition precedent stating that the insured must have implemented and maintained specific, up-to-date antivirus software and firewall configurations as verified by an independent IT audit conducted within the last 6 months prior to any claim. The insured has suffered a significant cyber attack and submitted a claim. Upon investigation, it is discovered that while the insured had the required software and configurations in place at the time of policy inception, their last independent IT audit was conducted 8 months ago, and there have been no subsequent verifications. The insurer is considering denying the claim. Which of the following approaches best reflects the professional and regulatory obligations in this situation? Option A. The claim as the insured had the necessary security measures in place at policy inception, and the delay in the audit was an oversight. Option B. Deny the claim immediately due to the unmet condition precedent, as the independent IT audit was not conducted within the specified timeframe. Option C. Waive the condition precedent due to the severity of the cyber attack and the potential reputational damage to the insured if the claim is denied. Option D. Investigate further to determine if the cyber attack would have occurred even with a recent audit, and consider a partial settlement based on this assessment. The correct answer is B. Deny the claim immediately due to the unmet condition precedent, as the independent IT audit was not conducted within the specified time frame. Explanation: scenario analysis. This scenario presents a common challenge in insurance where a policyholder's actions or circumstances directly impact the validity of their coverage. The difficulty lies in interpreting the precise wording of a condition precedent, determining whether it has been met, and understanding the consequences of non-compliance within the specific legal and regulatory framework of the London market. Professionals must navigate the contractual obligations of both insurer and insured, adhering to principles of good faith and regulatory expectations regarding policy clarity and enforcement. Correct approach analysis. The correct approach involves a thorough review of the policy wording, specifically the condition precedent clause, and an objective assessment of whether the insured's actions demonstrably fulfilled the stipulated requirement. This aligns with the fundamental principle that conditions precedent must be strictly met for cover to attach. In the London market, adherence to the Insurance Act 2015 and relevant market practices is paramount. The Act emphasizes the importance of clear policy terms and fair treatment of policyholders. If the condition was indeed a condition precedent and it was not met, the insurer is entitled to deny the claim, provided this is communicated clearly and in accordance with regulatory guidance on claims handling. Incorrect approach is analysis, an approach that focuses solely on the insurer's financial exposure without a rigorous assessment of the policy terms, and the insured's compliance fails to uphold the contractual agreement and regulatory expectations. This could be seen as acting in bad faith, an approach that assumes the condition was met without concrete evidence or a clear interpretation of the policy wording, risk setting a dangerous precedent and potentially misleading the policyholder about their coverage. This demonstrates a lack of due diligence and adherence to contractual obligations, an approach that seeks to waive the condition precedent based on a subjective feeling of sympathy for the policyholder, without a clear contractual basis or regulatory permission, undermines the integrity of the insurance contract and the principles of risk underwriting. This can lead to adverse selection and financial instability for the insurer. Professional reasoning. Professionals should adopt a systematic approach. 1. Understand the policy. Carefully dissect the policy wording, paying close attention to the definition and scope of any conditions precedent. 2. Gather evidence. Objectively collect all relevant information and evidence pertaining to the insured's actions or circumstances in relation to the condition. 3. Legal and regulatory interpretation. Consult legal counsel and relevant market guidelines to interpret the condition precedent and its implications under UK law and London market practices. 4. Objective assessment. Make an impartial judgment on whether the condition precedent has been satisfied based on the evidence and legal interpretation. 5. Clear communication. If the condition is not met and cover is denied, communicate this clearly and promptly to the policyholder, explaining the reasons and referencing the specific policy clause. Question 9. The risk matrix shows a potential for significant business interruption due to supply chain disruption. The client, a manufacturer, requests a policy wording that explicitly states all consequential losses arising from any interruption to the supply chain, regardless of cause. The underwriter is concerned that this wording is overly broad and may not align with standard market practice or the underlying risk appetite. What is the most appropriate approach for the underwriter? Option A. Accept the client's proposed wording verbatim to ensure client satisfaction and avoid potential disputes over coverage. Option B. Reject the proposed wording outright and insist on using the insurer's standard business interruption wording without further discussion. Option C. Advise the client that such broad coverage is not available in the London market and suggest they seek alternative insurance solutions. Option D. Discuss the client's specific concerns and the intent behind their proposed wording with the broker, and then propose a revised wording that accurately reflects the risk and is compliant with insurance contract law principles. The correct answer is A. Accept the client's proposed wording verbatim to ensure client satisfaction and avoid potential disputes over coverage. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between a client's desire for a specific policy wording and the underwriter's duty to ensure the policy accurately reflects the risk and complies with regulatory principles. The underwriter must balance commercial considerations with their professional obligations to avoid misrepresentation and ensure the policy is legally sound and commercially viable. The challenge lies in interpreting the client's request within the bounds of insurance contract law principles, particularly regarding utmost good faith and the definition of terms. Correct approach analysis. The correct approach involves a thorough review of the proposed wording against the established principles of insurance contract law, specifically focusing on clarity, accuracy, and the avoidance of ambiguity. This includes ensuring that the terms used are legally defined and understood within the London market context, and that the proposed wording does not create a misleading impression of coverage. The underwriter should engage in a dialogue with the broker to understand the precise intent behind the client's request and to explain the implications of the proposed wording under relevant UK insurance law and market practices. This upholds the principle of utmost good faith by ensuring both parties have a clear and accurate understanding of the contract's terms and the risks being insured. It also aligns with the regulatory expectation that insurance contracts are fair, transparent, and do not mislead policyholders. Incorrect approach is analysis. Adopting the client's proposed wording without critical evaluation fails to uphold the underwriter's professional responsibility to ensure the policy accurately reflects the risk and complies with legal and market standards. This approach risks creating an ambiguous or misleading contract, potentially leading to disputes and regulatory scrutiny. It breaches the duty of utmost good faith by not ensuring the client fully understands the implications of the wording. Suggesting alternative wording that significantly alters the nature of the risk without clear communication and agreement from the client is also problematic. While aiming for clarity, this approach could be seen as imposing terms that the client has not agreed to, potentially leading to a contract that does not meet their needs or expectations. This could also be viewed as a failure in the duty of good faith if the client is not fully informed of the changes and their impact. Refusing to consider any amendments and insisting on standard wording, without understanding the client's specific needs or the rationale behind their request, demonstrates a lack of commercial awareness and a failure to engage constructively. While adherence to standard practices is important, a rigid refusal to explore reasonable adjustments can hinder business and may not always be in line with the spirit of providing appropriate insurance solutions. Professional reasoning. Professionals should approach such situations by first seeking to understand the client's underlying need and the rationale for their proposed wording. This involves open communication with the broker. Subsequently, the professional must critically assess the proposed wording against established legal principles of insurance contract law, including clarity, accuracy, and the avoidance of misrepresentation. If the proposed wording is problematic, the professional should clearly articulate the concerns, referencing relevant legal principles and market practices, and propose alternative solutions that achieve the client's objective while remaining compliant and commercially sound. This iterative process of communication, analysis, and proposal ensures that the final contract is both legally robust and meets the reasonable expectations of the policyholder, thereby upholding the principles of utmost good faith and regulatory compliance. Question 10. Market research demonstrates a growing demand for competitive D&O insurance in the UK market, leading to the emergence of new, less established insurers seeking to gain market share. A broker receives an attractive quote from such an insurer for a significant D&O policy. The broker has no prior experience with this insurer and has not conducted any independent financial or reputational checks on them. The client is eager to secure the most cost-effective cover. Which of the following represents the most appropriate course of action for the broker? Option A. Conduct thorough due diligence on the new insurer's financial stability, claims handling capabilities, and regulatory standing before presenting the quote or recommending placement. Option B. Present the attractive quote to the client immediately, highlighting the cost savings, and proceed with binding the cover if the client agrees. Option C. Decline to place the business with the new insurer due to their lack of established reputation and seek cover from a more familiar, albeit potentially more expensive, insurer. Option D. Inform the client that the new insurer is unproven and suggest they seek cover directly from the insurer to avoid any perceived broker risk. Correct answer is B. Present the attractive quote to the client immediately, highlighting the cost savings, and proceed with binding the cover if the client agrees. Explanation. This scenario presents a professional challenge due to the inherent conflict between a broker's duty to their client and the potential for increased business from a new, albeit potentially problematic, insurer. The broker must navigate the principles of utmost good faith, professional diligence, and the regulatory expectations of the London market, particularly concerning the suitability of insurers for placing client business. The core difficulty lies in balancing the client's immediate desire for a competitive quote with the broker's responsibility to ensure the insurer is financially sound and capable of meeting its obligations, thereby protecting the client from future claims disputes or non-payment. The correct approach involves a thorough due diligence process on the proposed new insurer, focusing on their financial stability, claims handling reputation, and regulatory standing within the London market. This aligns with the broker's duty of care and professional diligence, as mandated by regulatory bodies and market practice. Specifically, under the FCA's principles for businesses, firms must conduct their business with due skill, care, and diligence, and act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes ensuring that the products and insurers recommended are appropriate and reliable. The broker must verify the insurer's solvency, its track record in handling similar financial lines risks, and any public information regarding its financial health or regulatory scrutiny. If concerns arise, the broker must communicate these transparently to the client and explore alternative, reputable insurers. An incorrect approach would be to immediately accept the new insurer's terms and present the quote to the client without independent verification. This fails to uphold the duty of care and professional diligence, potentially exposing the client to significant risk if the insurer is not financially sound. It also breaches the principle of acting in the client's best interests, as a cheap quote from an unreliable insurer is ultimately detrimental. Another incorrect approach would be to dismiss the new insurer outright without any investigation, which could be seen as a failure to explore all reasonable options for the client, potentially missing a genuinely competitive and sound market offering. However, the primary ethical and regulatory failure lies in proceeding without due diligence. A third incorrect approach would be to present the quote, but fail to disclose the broker's lack of familiarity with the insurer or the limited due diligence performed, thereby misleading the client about the insurer's standing. The professional decision-making process should involve a systematic evaluation of any proposed insurer, especially new entrants or those with limited track records. This includes 1. Initial screening for regulatory authorization and basic financial indicators. 2. Deeper investigation into financial strength ratings from reputable agencies, claims paying history, and market reputation. 3. Consideration of the insurer's expertise in the specific class of business being placed, e.g., D&O, PI, crime. 4. Transparent communication with the client regarding the insurer's profile and any identified risks, allowing the client to make an informed decision, with the broker providing clear recommendations. Question 11. Market research demonstrates that a proposer seeking cover for a novel technology-based logistics service has provided a summary of their business model and a high-level overview of their risk management framework. The underwriter has identified potential exposures related to data security, operational downtime due to technological failure, and third-party liability arising from the delivery process. Which approach best facilitates the formation of an insurance contract while adhering to the principles of risk assessment and utmost good faith? Option A. Issuing a binder based on the general assurances provided, assuming the risk management framework is adequate for a technology-based service. Option B. Relying on industry-wide statistics for similar technology logistics firms to estimate the risk and set terms. Option C. Requesting detailed documentation on the specific data security protocols, contingency plans for technological failures, and evidence of robust third-party contractual agreements. Option D. Deferring the assessment until the proposer can provide a comprehensive, independently audited risk report, without specifying interim steps. The correct answer is C. Requesting detailed documentation on the specific data security protocols, contingency plans for technological failures, and evidence of robust third-party contractual agreements. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for accurate risk assessment with the principles of contract formation, specifically the duty of utmost good faith. The underwriter must ensure that the information provided by the proposer is sufficient to form a binding contract, but also that the assessment is fair and reflects the true risk, without introducing undue bias or making assumptions that could invalidate the contract. Careful judgment is required to determine when further information is necessary versus when the existing information is adequate for a preliminary assessment, and the issuance of a cover note or binder. The correct approach involves requesting specific, relevant information that directly addresses the identified risk factors. This aligns with the principle of utmost good faith, uberrimi fidei, which requires both parties to disclose all material facts. By seeking clarification on the operational procedures and the specific risk mitigation measures in place, the underwriter is fulfilling their duty to conduct a thorough risk assessment before committing the market to cover. This proactive approach ensures that the terms of the potential contract accurately reflect the risk being insured, preventing adverse selection and ensuring fair pricing. It also provides a clear audit trail for the decision-making process, demonstrating due diligence. An incorrect approach that relies solely on the proposer's general assurances without seeking specific details fails to uphold the duty of utmost good faith. This could lead to a contract being voidable if material facts were misrepresented or not fully disclosed, as the underwriter has not taken reasonable steps to ascertain the true nature of the risk. Another incorrect approach, which involves making broad assumptions about the risk based on industry averages without specific inquiry, also breaches the duty of utmost good faith. Such assumptions may not accurately reflect the unique circumstances of the proposer and could result in inadequate pricing or inappropriate terms, potentially exposing the market to unforeseen losses. A third incorrect approach, which is to delay the assessment indefinitely without clear communication or a defined path forward, is professionally unacceptable as it hinders the formation of a contract and fails to manage the proposer's expectations, potentially damaging the market's reputation. Professionals should adopt a structured decision-making process. This involves 1. Identifying the core risk presented by the proposer. 2. Determining what specific information is material to assessing that risk accurately. 3. Formulating clear, targeted questions to elicit that information. 4. Evaluating the received information against the identified risk factors. 5. If information is insufficient, clearly communicating the need for further details and the reasons why. 6. Proceeding with the assessment and contract formation only when sufficient information has been obtained to make a fair and informed decision, upholding the principles of utmost good faith and prudent risk management. Question 12. The risk matrix shows that a potential client in the logistics sector presents a slightly higher than average exposure to cyber-related business interruption due to their reliance on proprietary tracking software. The underwriter is considering using a standard cargo liability policy form, which approach best ensures compliance with London market regulatory principles and sound underwriting practice. Option A. Conduct a detailed assessment of the client's specific cyber risk profile and consider adding a bespoke endorsement to the cargo liability policy to clarify or enhance cyber-related business interruption coverage, or recommend a separate cyber insurance policy. Option B. Utilize the standard cargo liability policy form without modification, assuming it implicitly covers all foreseeable risks for this class of business. Option C. Apply a standard off-the-shelf endorsement designed for general business interruption, without specific consideration for the nuances of cyber risk in the logistics sector. Option D. Review the standard cargo liability policy form for any specific cyber exclusions, and if none are present, proceed with the standard form, relying on general business interruption clauses. The correct answer is B. Utilize the standard cargo liability policy form without modification, assuming it implicitly covers all foreseeable risks for this class of business. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for standardized policy wording, which promotes efficiency and consistency, with the imperative to accurately reflect the unique risks presented by a specific client. The London market operates under stringent regulatory oversight, primarily from the Prudential Regulation Authority (PRA) and the Financial Conduct Authority (FCA), which mandate that policy terms and conditions must be clear, fair, and not misleading. Misinterpreting or inadequately adapting standard policy forms can lead to coverage gaps, disputes, and regulatory sanctions. Careful judgment is required to identify when a standard form is sufficient and when bespoke endorsements or amendments are necessary to ensure adequate and appropriate coverage. The correct approach involves a thorough risk assessment that identifies any deviations from the typical risk profile for which the standard policy form was designed. This includes understanding the client's business operations, the specific perils they face, and any unique contractual obligations. If the assessment reveals that the standard wording does not adequately address these specific risks or introduces unintended exclusions, the underwriter must then consider appropriate endorsements or amendments. This ensures that the policy accurately reflects the agreed-upon terms and conditions, providing clarity for both the insurer and the insured, and adhering to regulatory principles of fairness and transparency. This aligns with the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which require firms to act in their customers' best interests and communicate information clearly, fairly, and not misleadingly. An incorrect approach would be to assume that a standard policy form, by its nature, is always sufficient for any client within a particular class of business. This overlooks the fundamental principle of underwriting, which is to assess and price individual risks. Relying solely on a standard form without considering specific client circumstances can lead to underinsuring or overinsuring the risk, potentially exposing the insurer to unforeseen losses or charging premiums that are not commensurate with the risk. This failure to adequately assess and reflect the specific risk in the policy wording could be seen as a breach of the duty of care owed to the client and a contravention of regulatory expectations for prudent risk management and fair customer treatment. Another incorrect approach is to apply a standard endorsement designed for a different type of risk without a clear understanding of its implications for the current policy. Standard endorsements are often developed for specific situations, and their indiscriminate application can inadvertently alter coverage in ways that are not intended or understood by either party. This can lead to disputes over coverage and may not adequately address the client's actual needs, potentially violating regulatory requirements for clear and accurate policy terms. A third incorrect approach is to proceed with the standard policy form without any internal review or consultation, even when the underwriter has identified potential ambiguities or areas where the standard wording might not be a perfect fit. This bypasses the internal controls and expertise that are crucial in the London market for ensuring policy integrity and compliance. It demonstrates a lack of diligence and can lead to systemic issues if not identified and corrected. The professional decision-making process for similar situations should involve a systematic review of the client's submission, a critical evaluation of the proposed standard policy form against the identified risks, consultation with subject matter experts or senior underwriters when necessary, and a clear articulation of any amendments or endorsements made, ensuring they are understood and agreed upon by all parties. This process prioritizes accurate risk representation, regulatory compliance, and the maintenance of trust within the insurance market. Question 13. The assessment process reveals that a broker is assisting a client in obtaining a complex property insurance policy. During the information gathering phase, the broker learns that the client has had several significant claims in the past 3 years related to fire damage at their properties, which they are hesitant to fully disclose to the underwriter, suggesting they are not that important. The broker is aware that this claim's history is material to the underwriter's assessment of the risk and the premium to be charged. What is the most appropriate course of action for the broker in this situation, adhering strictly to the principles governing the London insurance market? Option A. The broker should downplay the severity of the past claims in the submission to the underwriter, focusing only on the most recent and less significant incidents. Option B. The broker should omit the details of the past claims from the submission to the underwriter, as the client has indicated they are not important. Option C. The broker should fully disclose the client's claims history to the underwriter, explaining its relevance, and advise the client that this information is material and must be disclosed for the policy to be valid. Option D. The broker should advise the client that they can choose whether or not to disclose the claim's history, as it is ultimately the client's decision. The correct answer is C. The broker should fully disclose the client's claims history to the underwriter, explaining its relevance, and advise the client that this information is material and must be disclosed for the policy to be valid. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest and the potential for misrepresentation of risk. A broker, acting as an intermediary, has a fiduciary duty to both the client and the underwriter. This duty requires transparency and honesty in presenting information. The underwriter, in turn, relies on the broker's accurate representation of the risk to make informed underwriting decisions. The insurer's financial stability and the integrity of the market depend on accurate risk assessment and pricing. Lloyd's of London, as a marketplace, has a vested interest in maintaining its reputation for fair dealing and robust underwriting practices. The correct approach involves the broker acting with utmost good faith and transparency. This means disclosing all material facts, even those that might negatively impact the client's chances of securing cover or the premium charged. The broker should clearly communicate to the underwriter that the client has a history of claims, as this is a material fact directly relevant to the risk assessment. This aligns with the principles of insurance law, particularly the duty of disclosure, and upholds the ethical standards expected of intermediaries in the London insurance market. By being transparent, the broker ensures the underwriter can price the risk appropriately, protecting both the insurer and the insured. An incorrect approach would be for the broker to omit or downplay the client's claims history. This constitutes a breach of the duty of disclosure, which is a fundamental principle in insurance. Such an omission misleads the underwriter, potentially leading to underpricing of the risk and subsequent financial losses for the insurer. It also violates the ethical obligation to act with integrity and honesty, undermining the trust essential for the functioning of the insurance market. Furthermore, it could expose the broker to professional sanctions and legal liabilities. Another incorrect approach would be for the broker to unilaterally decide that the claim's history is not significant enough to warrant disclosure without consulting the client or seeking clarification from the underwriter. This demonstrates a lack of professional judgment and an abdication of responsibility. The broker's role is to facilitate informed decision-making, not to make subjective judgments about the materiality of risk factors without proper consideration. A third incorrect approach would be for the broker to suggest to the client that they should not disclose the claim's history. This is ethically reprehensible and legally unsound, as it actively encourages a breach of the duty of disclosure. It places the broker in a position of complicity in misrepresentation and jeopardizes the client's insurance coverage, as the policy could be voided if the non-disclosure is discovered. Professionals should approach such situations by first understanding their duty of utmost good faith and disclosure. They must then identify all material facts relevant to the risk. If there is any doubt about the materiality of a fact, it is always best practice to disclose it. Open communication with both the client and the underwriter is paramount. If a client is reluctant to disclose, the broker should explain the legal and ethical implications and the potential consequences for their coverage. The broker's primary responsibility is to ensure the integrity of the insurance transaction. Question 14. What factors determine the most effective approach for a London market insurance firm to assess the impact of new regulatory requirements on its operations and client services? Option A. The historical precedent of similar regulatory changes and the general market sentiment towards compliance, without a specific analysis of the firm's unique operational context. Option B. The perceived urgency of the regulatory change and the availability of internal resources to implement new procedures, with minimal consideration for external stakeholder feedback. Option C. The extent to which the new regulations necessitate changes to existing IT systems and data handling processes, alongside the potential impact on client communication channels and the firm's overall risk appetite. Option D. The cost-effectiveness of the proposed compliance solutions and the ease with which they can be integrated into current workflows, irrespective of potential client-facing implications. The correct answer is C. The extent to which the new regulations necessitate changes to existing IT systems and data handling processes, alongside the potential impact on client communication channels and the firm's overall risk appetite. Explanation. This scenario is professionally challenging because it requires a firm to navigate the complex and evolving regulatory landscape of the London insurance market, specifically concerning the implementation of new compliance measures. The firm must balance the need for robust regulatory adherence with operational efficiency and the potential impact on client service. Careful judgment is required to ensure that the chosen approach not only meets the letter of the law, but also upholds the spirit of regulatory intent, fostering trust and market integrity. The correct approach involves a proactive and comprehensive impact assessment that considers all relevant stakeholders, potential operational disruptions, and the financial implications of the new regulations. This approach is right because it aligns with the Financial Conduct Authority's (FCA) principles of treating customers fairly and maintaining market integrity. By thoroughly evaluating the impact, the firm can identify potential risks and develop mitigation strategies, ensuring a smooth transition and minimizing negative consequences for clients and the business. This demonstrates a commitment to regulatory compliance as a strategic imperative, not merely a box-ticking exercise. An incorrect approach that focuses solely on the immediate cost savings of a new system, without considering its long-term regulatory implications or potential impact on client data security, fails to meet the FCA's expectations for robust risk management. This could lead to breaches of data protection regulations and a failure to treat customers fairly, potentially resulting in significant fines and reputational damage. Another incorrect approach that prioritizes speed of implementation over thoroughness, by skipping detailed impact analysis and relying on assumptions, risks overlooking critical compliance gaps. This could result in non-compliance with specific regulatory requirements, such as those related to reporting or consumer protection, leading to regulatory scrutiny and enforcement action. A further incorrect approach that delegates the entire impact assessment to a junior team without adequate oversight or senior management buy-in demonstrates a lack of commitment to compliance at the leadership level. This can lead to a superficial understanding of the regulatory requirements and a failure to embed compliance effectively within the firm's culture and operations, increasing the likelihood of regulatory breaches. Professionals should adopt a structured decision-making framework that begins with a clear understanding of the regulatory objective. This should be followed by a comprehensive assessment of potential impacts across all business functions, engaging relevant stakeholders, and developing a detailed implementation plan with clear responsibilities and timelines. Regular review and adaptation of the plan based on ongoing monitoring and feedback are crucial for sustained compliance. Question 15. Examination of the data shows a pattern of multiple claims submitted within a short period, each exhibiting minor but identical discrepancies in the reported incident details, originating from policyholders who share a common geographical postcode. What is the most appropriate regulatory compliant approach for the underwriter to adopt? Option A. Reject all claims immediately due to the suspicious nature of the discrepancies, without further investigation. Option B. Proceed with the settlement of all claims promptly to maintain good customer relations and operational efficiency, assuming the discrepancies are coincidental. Option C. Flag these claims for detailed review by the Internal Fraud Detection Unit, requesting further documentation and cross-referencing policyholder information for any links. Option D. Advise the policyholders to resubmit their claims with corrected details, without initiating any internal review of the pattern. The correct answer is B. Proceed with the settlement of all claims promptly to maintain good customer relations and operational efficiency, assuming the discrepancies are coincidental. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for efficient claims processing with the critical regulatory obligation to detect and prevent insurance fraud. The London market operates under a stringent regulatory environment, primarily governed by the Financial Conduct Authority, FCA, in the UK. The FCA's principles for businesses and specific conduct of business rules mandate that firms act with integrity, treat customers fairly, and have adequate systems and controls in place to prevent financial crime, including fraud. A failure to adequately address potential fraud can lead to significant reputational damage, regulatory sanctions, and financial losses for both the insurer and policyholders. The correct approach involves a proactive and systematic review of claims data for indicators of potential fraud, coupled with a clear escalation process. This aligns with the FCA's expectations for robust internal controls and risk management. Specifically, the FCA Handbook, particularly SISC, Systems and Controls, and ICOB's Insurance Conduct of Business Sourcebook, emphasizes the need for firms to have appropriate policies and procedures to identify, assess, and manage risks, including those related to fraud. A thorough review of suspicious claims, even if it delays immediate settlement, is a necessary step to uphold regulatory compliance and protect the integrity of the insurance market. This approach demonstrates a commitment to due diligence and responsible underwriting. An incorrect approach would be to dismiss suspicious patterns solely based on the volume of claims or the desire for swift resolution. For instance, ignoring multiple claims with similar, unusual characteristics across different policyholders, or failing to investigate discrepancies in submitted documentation, would represent a failure to implement adequate systems and controls as required by SISC. This could be interpreted as a lack of integrity and a failure to treat customers fairly, as it may allow fraudulent actors to benefit at the expense of honest policyholders and the wider market. Such an approach risks contravening the FCA's principles, potentially leading to enforcement action. Another incorrect approach would be to rely solely on automated systems without human oversight for fraud detection. While technology is a valuable tool, the FCA expects firms to have skilled personnel who can apply judgment and experience to interpret data and investigate complex cases. Over-reliance on automation without a robust human review process can lead to missed red flags or the misinterpretation of data, thereby failing to meet the regulatory standard for effective fraud prevention. The professional decision-making process in such situations should involve a risk-based approach. Underwriters and claims handlers must be trained to recognize common fraud indicators. When suspicious patterns emerge, the immediate priority should be to initiate a thorough investigation, adhering to established internal procedures. This may involve requesting further information from the policyholder, consulting with fraud investigation specialists, or escalating the matter to senior management. The decision to delay settlement should be based on a genuine concern for potential fraud, not merely on administrative convenience. Maintaining clear audit trails of all decisions and investigations is also crucial for demonstrating compliance. Question 16. When evaluating potential process optimization initiatives within a London market insurance firm's claims department, which approach best balances the drive for operational efficiency with the imperative to maintain high standards of policyholder service and regulatory compliance? Option A. Relying on feedback from experienced claims handlers to identify and implement changes that they believe will speed up their work, without formal data collection or analysis. Option B. Introducing a blanket policy to reduce the time allocated for each claims assessment by 15%, irrespective of claim complexity, to achieve immediate cost savings. Option C. Implementing automated decision-making for all claims below a certain value threshold based on predefined rules to expedite settlement and reduce manual intervention. Option D. Conducting a comprehensive review of the existing claims handling workflow, utilizing data analytics to identify specific bottlenecks and areas for improvement, and then piloting proposed changes with a focus on maintaining accuracy and fairness. The correct answer is C. Implementing automated decision-making for all claims below a certain value threshold based on predefined rules to expedite settlement and reduce manual intervention. Explanation. This scenario is professionally challenging because it requires balancing the need for efficiency in claims handling with the fundamental principles of fair treatment of policyholders and adherence to regulatory requirements. The pressure to reduce operational costs can inadvertently lead to shortcuts that compromise the integrity of the claims process. Careful judgment is required to ensure that process optimization does not lead to a reduction in the quality of service or a failure to meet contractual obligations. The correct approach involves a systematic review of the claims handling process, identifying bottlenecks and inefficiencies, and implementing changes that streamline operations without compromising accuracy, fairness, or regulatory compliance. This approach prioritizes data-driven analysis to understand the root causes of delays or errors, and it seeks solutions that enhance both efficiency and policyholder satisfaction. Specifically, it aligns with the principles of good governance and fair treatment of customers, which are central to the regulatory framework governing the London insurance market. The emphasis is on continuous improvement that benefits all stakeholders, including the insurer, the policyholder, and the market's reputation. An incorrect approach that focuses solely on cost reduction without considering the impact on claims handling quality would be professionally unacceptable. This could lead to rushed assessments, inadequate investigations, or a failure to adhere to policy terms, thereby breaching the duty of care owed to policyholders and potentially contravening regulatory requirements regarding fair claims settlement. Another incorrect approach that relies on anecdotal evidence or personal experience rather than objective data to identify areas for improvement would also be professionally unsound. This subjective method is prone to bias and may overlook systemic issues, leading to ineffective or even detrimental changes. It fails to demonstrate due diligence and a commitment to evidence-based decision-making, which are expected standards in a regulated market. A further incorrect approach that involves implementing changes without proper testing or validation would be risky and unprofessional. This could result in unintended consequences, such as new inefficiencies or errors, further disrupting the claims process and potentially harming policyholders. It demonstrates a lack of foresight and a failure to manage operational risks effectively. Professionals should adopt a decision-making framework that begins with a clear understanding of the current process, its objectives, and its performance metrics. This should be followed by a thorough analysis of potential improvements, considering their impact on efficiency, cost, policyholder experience, and regulatory compliance. Solutions should be piloted and evaluated before full implementation, with ongoing monitoring to ensure sustained effectiveness. This structured, data-driven, and risk-aware approach ensures that process optimization genuinely enhances the claims handling function while upholding the highest professional and regulatory standards. Question 17. Risk assessment procedures indicate a client wishes to secure a highly unusual and potentially uninsurable form of coverage for a novel business venture. The broker has significant experience, but is aware that the London market may have limited appetite for such a risk. Which of the following represents the most appropriate course of action for the broker? Option A. Conduct thorough due diligence on the client's risk. Engage with underwriters to assess market appetite and terms, and then provide the client with a comprehensive analysis of findings, including potential limitations and alternatives, before proceeding. Option B. Place the coverage with a domestic insurer outside the London market that has expressed a willingness to offer the coverage, without informing the client of the London market's potential capacity or the implications of using a non-London market insurer. Option C. Advise the client that the coverage is likely uninsurable and decline to pursue the placement, without further market exploration or explanation. Option D. Immediately attempt to place the coverage with any underwriter willing to accept it, regardless of terms or exclusions, to satisfy the client's request. The correct answer is D. Immediately attempt to place the coverage with any underwriter willing to accept it, regardless of terms or exclusions, to satisfy the client's request. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for a specific, potentially high-risk coverage with the broker's fiduciary duty to ensure the client understands the implications and that the proposed placement is in their best interest, adhering to market standards and regulatory expectations. The broker must navigate the tension between client instruction and professional responsibility, particularly when the instruction might lead to an unsuitable or uninsurable risk. The London insurance market's complexity and the broker's intermediary role necessitate a rigorous approach to risk assessment and advice. Correct approach analysis. The correct approach involves the broker conducting a thorough due diligence process, which includes understanding the client's business, the specific risks they face, and the available market capacity and appetite for such a risk. This entails engaging with underwriters to ascertain their willingness and terms for covering the proposed risk, and then clearly communicating these findings, including any limitations or exclusions, back to the client. The broker must provide informed advice, highlighting potential downsides and alternative solutions, enabling the client to make a truly informed decision. This aligns with the principles of acting with integrity, skill, care, and diligence, as expected under the FCA's principles for businesses and the principles of good market practice within the London market. The broker's role is not merely to execute instructions, but to advise and facilitate appropriate insurance solutions. Incorrect approaches analysis. One incorrect approach is to immediately place the cover as instructed without further investigation. This fails to uphold the broker's duty of care and skill. It bypasses the essential step of assessing market appetite and the suitability of the coverage for the client's actual risk profile, potentially exposing the client to inadequate protection or unmanageable terms. This could be seen as a breach of regulatory requirements to act in the client's best interests and to provide suitable advice. Another incorrect approach is to refuse to engage with the client's request outright, without attempting to understand the underlying need or exploring market possibilities. While the risk may be challenging, a complete refusal without exploration or explanation can be seen as a failure to serve the client effectively and to leverage their market knowledge. It doesn't demonstrate the skill and diligence expected of a professional broker. A third incorrect approach is to place the cover with minimal underwriting engagement, assuming the client's instruction overrides the need for thorough market assessment. This approach prioritizes transactional speed over client protection and professional responsibility. It risks placing a policy that may not be sustainable in the market or may contain significant uncommunicated limitations, ultimately failing the client and potentially breaching market conduct expectations. Professional reasoning. Professionals should adopt a structured decision-making framework. First, fully understand the client's stated objective and underlying business need. Second, assess the feasibility and appropriateness of the requested coverage in the current market. Third, engage with the market underwriters to gauge appetite and terms. Fourth, clearly and comprehensively communicate findings, including risks, limitations, and alternatives, to the client. Fifth, document all advice and client decisions. This process ensures that client instructions are met where possible, but always within the bounds of professional responsibility, regulatory compliance, and ethical conduct, prioritizing the client's best interests and informed consent. Question 18. The efficiency study reveals that a significant number of retrospective endorsements are being processed in the London market. One particular endorsement alters the terms of coverage for a period that has already concluded, with the additional premium being calculated and paid after the expiry of the original policy period. Considering the fundamental principles of contract law applicable to insurance in the London market, which of the following best describes the legal standing of such an endorsement regarding consideration? Option A. The endorsement is invalid due to a lack of consideration because the premium is paid after the period of cover has ended, meaning no new value was exchanged during the original policy term. Option B. The endorsement is merely an administrative adjustment and therefore does not require new consideration to be legally effective. Option C. The endorsement lacks consideration as the insurer is not undertaking any new risk, but rather confirming existing coverage for a past event. Option D. The endorsement is likely supported by valid consideration as the insurer assumes a risk for a past period, and the insured agrees to pay an additional premium for this assumption of risk, representing a mutual exchange of value. The correct answer is D. The endorsement is likely supported by valid consideration as the insurer assumes a risk for a past period, and the insured agrees to pay an additional premium for this assumption of risk, representing a mutual exchange of value. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the concept of consideration within the context of London market insurance contracts, specifically when dealing with retrospective endorsements. The challenge lies in identifying whether a valid exchange of value exists, which is a fundamental requirement for a legally binding contract. Misinterpreting consideration can lead to disputes over policy validity and coverage. The correct approach involves recognizing that a retrospective endorsement, which alters coverage for a past period, can be supported by valid consideration if there is a genuine mutual benefit or detriment exchanged. This might include the insurer agreeing to extend cover for a period where a loss has occurred, thereby assuming a risk they might not have otherwise, and the insured agreeing to pay an additional premium for this extended protection. This mutual exchange of promises and potential liabilities constitutes valid consideration, fulfilling the legal requirement for contract formation or variation. This aligns with the principles of contract law as applied in the UK insurance market, where consideration must be something of value in the eyes of the law, moving from the promisee to the promiser. An incorrect approach would be to assume that any retrospective endorsement automatically lacks consideration because the premium is paid after the period of cover. This overlooks the fact that the insurer is undertaking a new obligation or assuming a risk for a past period, which is a detriment to them and a benefit to the insured, regardless of when the premium is formally accounted for. Another incorrect approach would be to focus solely on the timing of the premium payment, without considering the insurer's assumption of risk for the past period. The essence of consideration is the bargain struck, not merely the chronological order of payment. A further incorrect approach would be to argue that a retrospective endorsement is merely an administrative adjustment and therefore requires no new consideration. This fails to acknowledge that altering the terms of an existing contract, even retrospectively, typically requires fresh consideration to be legally effective, unless it is a simple correction of a factual error. Professionals should approach such situations by first identifying the core elements of contract law, particularly the requirement for consideration. They must then analyze the specific terms of the endorsement and the circumstances surrounding its agreement to determine if there has been a genuine exchange of value. This involves looking beyond superficial aspects like payment timing and focusing on the mutual obligations and risks undertaken by both parties. Consulting legal counsel or senior underwriters experienced in London market practices is advisable when there is any doubt about the validity of consideration. Question 19. Regulatory review indicates that an underwriter is considering a proportional reinsurance treaty to increase underwriting capacity for a specific class of business. The cedent is a well-established entity in the London market, and there is significant market demand for this type of capacity. However, the underwriter has not yet conducted a detailed review of the treaty's specific terms and conditions, relying instead on the cedent's reputation and the general market appetite. Which approach best aligns with the regulatory framework and principles for prudent reinsurance management in the London market? Option A. Proceed with the treaty, but request a higher premium to compensate for the perceived risk of not fully understanding the treaty's specifics. Option B. Conduct a comprehensive review of the treaty's terms, conditions, and scope to ensure it aligns with the insurer's risk appetite, underwriting guidelines, and regulatory capital requirements before acceptance. Option C. Accept the treaty based on the cedent's reputation and market demand, as this demonstrates sound market practice and ensures timely capacity provision. Option D. Delegate the detailed review of the treaty to the cedent's broker, assuming they will act in the insurer's best interest due to the established relationship. The correct answer is C. Accept the treaty based on the cedent's reputation and market demand, as this demonstrates sound market practice and ensures timely capacity provision. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the immediate need for capacity with the long-term implications for the insurer's risk appetite and regulatory compliance. Misjudging the suitability of a reinsurance treaty could lead to an unmanageable accumulation of risk, potentially jeopardizing the insurer's solvency and its ability to meet policyholder obligations, which are core concerns for the Prudential Regulation Authority, PRA, under the Financial Services and Markets Act 2000 FSMA, and related Solvency Roman II regulations. Correct approach analysis. The correct approach involves a thorough assessment of the proposed reinsurance treaty's alignment with the insurer's established underwriting guidelines and risk appetite. This means evaluating whether the treaty's terms, conditions, and scope of coverage are appropriate for the underlying risks being reinsured. Specifically, the underwriter must confirm that the treaty does not expose the insurer to risks that are outside its defined risk appetite or that could lead to excessive concentration of risk. This aligns with the PRA's expectations for robust risk management frameworks and the need for insurers to maintain adequate capital to cover their liabilities, as mandated by Solvency Roman II. The principle is to ensure that reinsurance is used strategically to manage risk effectively, not to offload risks that the insurer is not equipped to underwrite or retain. Incorrect approaches analysis. One incorrect approach would be to accept the reinsurance treaty solely based on the cedent's reputation and the perceived market demand for capacity, without a detailed review of the treaty's specific terms and their impact on the insurer's risk profile. This failure to conduct due diligence on the treaty's substance, focusing instead on superficial factors, could lead to the insurer inadvertently taking on risks it does not understand or cannot manage, contravening the PRA's emphasis on prudent risk management and potentially breaching Solvency Roman II capital requirements. Another incorrect approach would be to assume that any treaty offered by a reputable reinsurer automatically meets the insurer's risk appetite. This assumption bypasses the critical step of verifying that the treaty's coverage and limitations are consistent with the insurer's own underwriting philosophy and risk tolerance. Such an oversight could result in the insurer being exposed to unforeseen liabilities or a mismatch between the reinsured risks and the insurer's capital, which is a direct violation of the principles of sound financial management and regulatory oversight by the PRA. A further incorrect approach would be to prioritize securing the reinsurance capacity quickly to meet immediate business needs without adequately considering the long-term implications for the insurer's risk portfolio. While speed is often important in the London market, it cannot come at the expense of prudent risk assessment. This approach neglects the fundamental regulatory requirement to maintain a sustainable and well-managed risk profile, potentially leading to future financial instability and regulatory scrutiny from the PRA. Professional reasoning. Professionals should adopt a structured approach to evaluating reinsurance treaties. This involves 1. Understanding the insurer's risk appetite and underwriting guidelines. 2. Conducting thorough due diligence on the proposed reinsurance treaty, examining its terms, conditions, scope, and exclusions. 3. Assessing the treaty's alignment with the insurer's overall risk management strategy and capital adequacy. 4. Considering the cedent's financial strength and reputation, but not as a substitute for treaty analysis. 5. Documenting the decision-making process, including the rationale for acceptance or rejection. This systematic process ensures that reinsurance is utilized as a strategic tool for risk management, in compliance with regulatory expectations and ethical obligations to policyholders and stakeholders. Question 20. The assessment process reveals that a syndicate is considering underwriting a novel form of business interruption coverage linked to the disruption of global supply chains caused by geopolitical events. The proposed policy wording is complex and extends beyond traditional property damage triggers. Which of the following approaches best demonstrates adherence to the regulatory framework and London market principles for this scenario? Option A. Classifying the risk as a new, standalone class of geopolitical supply chain disruption insurance and seeking specialist advice and potentially regulatory clarification on its unique characteristics and appropriate oversight. Option B. Placing the coverage under the general liability class, as the disruption could be seen as a consequence of third-party actions. Option C. Underwriting the risk under the existing property damage class, assuming the business interruption element is a standard extension. Option D. Applying the principles of marine cargo insurance, as supply chains inherently involve the movement of goods. The correct answer is C. Underwriting the risk under the existing property damage class, assuming the business interruption element is a standard extension. Explanation. The assessment process reveals a common challenge in the London market, ensuring that the underwriting of complex, non-standard risks aligns with both market best practices and the specific regulatory requirements governing insurance in the UK. This scenario is professionally challenging because it requires a nuanced understanding of how different classes of insurance are treated under the Financial Conduct Authority, FCA handbook, particularly CISC, senior management arrangements, systems and controls, and ICOBs, insurance conduct of business sourcebook, as well as the specific principles of the London market. A failure to correctly classify and underwrite a risk can lead to regulatory breaches, financial losses, and reputational damage. Careful judgment is required to distinguish between risks that fall under established market syndicates and those that might require specialist expertise or even be uninsurable through standard London market channels. The correct approach involves a thorough understanding of the risk's characteristics and its alignment with the defined parameters of the specific insurance class being considered. This means accurately identifying whether the risk fits within the established underwriting appetite of the syndicate and adheres to the regulatory definitions and requirements for that class. For example, understanding the nuances of marine, aviation, or energy insurance and how they are regulated under the FCA is paramount. This approach ensures compliance with the FCA's principles for businesses, particularly Principle 3, Management and Control, and Principle 6, Customers' Interests, by ensuring that risks are underwritten prudently and that customers are treated fairly. It also upholds the integrity of the London market by maintaining clear lines of responsibility and expertise. An incorrect approach that relies on a superficial understanding of the risk and its classification is professionally unacceptable. This could manifest as attempting to place a highly specialized cyber risk under a general liability policy without adequate consideration of the specific cyber insurance regulations and market expertise. Such an action would likely violate CISC requirements for adequate systems and controls, as the syndicate may not have the necessary expertise or risk appetite for such a specialized class. Furthermore, it could breach ICOB's requirements concerning fair treatment of customers, as the policy may not provide appropriate coverage or the terms may be misunderstood. Another incorrect approach would be to assume that because a risk has some tangential connection to a traditional class, it can be underwritten within that class without further scrutiny. This ignores the principle of true risk and can lead to mispriced policies and regulatory scrutiny for inadequate risk assessment and control. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with a detailed understanding of the risk's nature, scope, and potential exposures. It then requires consulting relevant FCA handbook sections, market guidance, and internal underwriting authorities to determine the appropriate insurance class. If there is any doubt, seeking advice from specialist underwriters, claims handlers, or compliance officers within the London market is essential. The decision should be documented thoroughly, justifying the classification and underwriting approach based on regulatory compliance and sound insurance principles.